Something is seriously wrong at the very core of the American economy. Most people just haven't noticed it yet. At first glance, everything seems stable. Stock markets keep climbing, unemployment remains low, and major US corporations continue to spend and borrow money as if nothing is happening. But behind the scenes, a financial time bomb is quietly ticking. Not long ago, Jeffrey Gundlach, a man who doesn't panic without reason, issued a serious warning. He's not called the Bond King for nothing. In the financial world, people listen to what he says. Speaking at the Bloomberg Global Credit Forum, he revealed that his company, Double Line Capital, had reduced its exposure to junk bonds to a record low. And this wasn't just caution, it was a retreat from a market he considers unstable. So why would someone like Gundlach pull out of high-yield bonds, which usually offer strong returns? The answer is simple and unsettling. The risk no longer justifies the reward. The market is flooded with bad debt and is on the verge of collapse. At least $50 billion in corporate bonds are teetering on the edge of default. If they start to fall, it will be loud. This isn't just market turbulence. It could trigger a chain reaction that shakes corporate America to its foundations. Is the United States once again heading toward a financial crisis that's been hiding in plain sight all along? Let's take a closer look. First, we need to understand where the threat lies. The name junk bonds says it all. These are debts issued by companies with low credit ratings. In other words, promises made by businesses already in shaky financial shape. To attract investors, they offer high yields, but the risks are massive. In good times, investors were willing to take that risk. Junk bonds paid more than safe government securities. But something has changed. The difference in yields between junk bonds and US Treasury bonds, the so-called credit spread, has shrunk to 3.2%. That's an extremely low figure by historical standards. In fact, the situation is eerily reminiscent of 2007, just before the global financial meltdown. Back then, markets ignored obvious warning signs, and people believed housing prices would rise forever. Today, they may be making the same mistake, but this time with corporate debt. Despite many companies being neck-deep in liabilities, investors act like everything's fine. They're chasing returns and losing caution. But this isn't smart investing, it's dangerous complacency. And Gundlach isn't the only one sounding the alarm. JP Morgan Chase CEO Jamie Dimon also recently stated that if he were running a bond fund, he wouldn't go anywhere near the current market. That's not just an offhand comment, it's the opinion of the head of the largest bank in the United States. At the center of his concern is the US Treasury bond market, long considered the world's safest financial instrument. But now that foundation is beginning to crack. Dimon speaks of a toxic cocktail, a national debt nearing $37 trillion, a growing budget deficit, uncontrolled stimulus spending, and interest payments that have already surpassed $1 trillion per year. He harshly criticized Washington for catastrophic financial mismanagement and pointed out that debt is growing faster than the economy. He also reminded everyone that after the 2008 crisis, new regulations limited banks' ability to intervene during market shocks. Today, the system can be described in 3 words: bloated, blind, and unstable. If you need proof, just look at what happened in the year 2022. The United Kingdom nearly lost control of its debt market after an unexpected budget announcement that shook public finances. The Bank of England was forced to step in urgently to prevent the collapse of pension funds. Now imagine the same scenario, but on a scale 10,000 times larger. That is the United States Treasury bond market. Major institutional investors, pension funds, sovereign wealth funds, insurance companies, have already started to retreat. Recent Treasury auctions show weak demand. In order to attract buyers, yields on certain bonds are already being raised. Even inside JP Morgan, they are now reworking their risk models. And that is always a troubling sign. Jamie Dimon is not an alarmist. He simply reads the numbers, and numbers do not lie. The same concern is echoed by Josh Easterly from 6th Street Partners. These are not random analysts off the street. These are heavyweights in the financial world. Speaking on Bloomberg, he warned that the private credit market is highly overvalued. Money is flowing in at record levels, but the quality of the loans is not improving. The gap between risk and reward is narrowing when it should be widening, and that is already a major red flag. Josh Easterly pointed out that many investors are ignoring 2 key threats: changing interest rates and the weak financial resilience of borrowers. Right now, floating rate loans may seem attractive, but as soon as central banks begin to cut rates, those yields will vanish. And in a slowing economy, bad loans become ticking time bombs. But what about traditional lending secured by investment funds? According to Easterly, there is no real profit left in that space. Sixth Street has now shifted its focus to complex, custom-built deals, where they can structure risk from the ground up. In just the first quarter alone, 84% of their direct lending went to transactions outside the traditional private equity fund sector. This is not just a strategic shift, it is a retreat, a reconfiguration. And considering they manage over $100 billion in assets, such a move reflects deep concern. But here's the real question: will anyone actually listen this time? What's strange is that while professionals are pulling back from risk, retail investors are charging into it. Some recent junk bond issuances have been oversubscribed by 300 to 400%. Goldman Sachs estimates that next year, private companies could issue up to $1.5 trillion in high-risk bonds. So why the stark difference in behavior? The answer is desperation. Many still believe the Federal Reserve will step in to save the market, just as it did in 2020. But this time, that hope is misplaced. Today, the Fed's hands are tied. Its credibility depends on controlling inflation, not bailing out those who recklessly loaded up on debt. Counting on help now is an entirely different kind of bet. So while the experts are quietly stepping away, the crowd is rushing toward the cliff, hoping someone will stop the disaster at the last second. But that's not courage, it's financial recklessness. You don't have to wait for a future crisis. The signs are already here. For the first time in over a year, the number of American companies receiving credit rating downgrades has exceeded those getting upgrades. And more broadly, the United States itself has now been downgraded by 3 separate credit rating agencies. A downgrade means investors are losing confidence in a company's ability to repay its debt. And we're not just talking about small firms. These are major corporations whose names you've definitely heard. When a company with top-tier trustworthiness gets downgraded, it doesn't just hurt their stock, it shakes investor confidence across the entire market. If the strong are starting to weaken, what does that mean for those that were already on the edge? Here's the harsh truth. Most of these companies carry massive volumes of junk debt. If they cannot refinance, meaning take on new loans to pay off the old ones, they will default. And defaults will be contagious. This won't be a local fire, it'll be a chain reaction. The collapse of the junk bond market will hit pension funds, insurance companies, and even ordinary retirement savings. And when those debts begin to unravel, the shockwave will reach banks, the job market, and millions of households across the country. And that is without even factoring in the global instability. Right now, the situation around the world is only making the risks worse. The recent Israeli strikes on Iran sparked fears that the Strait of Hormuz could be blocked, a narrow passage through which around 20% of the world's oil supply flows. Any disruption there, and oil prices could skyrocket overnight. We've already seen what happens when prices jump like that. In early 2024, after a brief conflict in the region, oil surged to over $110 per barrel. Panic about inflation gripped the United States, and the Federal Reserve was forced to delay its plans to cut interest rates. This is a serious problem. Rising oil prices mean rising costs for businesses, in transportation, in production, across the board. That puts pressure on profit margins. And if inflation starts to rise again, the Fed will not be able to ease monetary policy to help debt-laden companies. It becomes a vicious cycle. Companies desperately need cheap borrowing, but instead face even higher interest rates. Imagine being deep in debt and suddenly your loan payments double. That is exactly what many companies could be facing in the coming months. Now add global chaos and expensive oil to the mix, and the entire debt pyramid of corporate America starts to look like a house of cards swaying in the wind. And here's what makes it even more frightening. A massive portion of corporate debt is not even visible to the public. It is hidden inside the so-called private credit market, a shadow sector estimated at around $2.5 trillion. These are loans issued not by banks, but by private funds, often without proper oversight or regulation. Private credit became popular after the 2008 crisis, when banks started avoiding risky borrowers. At first, it seemed like a safer alternative, but now it has turned into a blind spot. Many of these loans go to the same companies issuing junk bonds, only now without transparency or supervision. If these companies begin to collapse, we will not see the cracks until it is too late. We will not even know who holds the risk or how deep the losses might be. This kind of silent crisis can turn into a sudden catastrophe. Think back to 2008. First, a few mortgage companies went bankrupt, then banks started falling, and from there, chaos spread through the global economy. We are now seeing a similar pattern. While all of this is unfolding, inflation, once thought to be under control, is quietly creeping back. And for bondholders, this is more than just an inconvenience. It is a threat to their survival. Inflation silently eats away at returns. Each month, investors earn less in real terms. It is as if they are being paid in sand and the tide is rising. With each percentage point of inflation, real returns on debt decline. And for junk bonds, where the risk is already extreme, this is especially dangerous. The damage is already visible. In 2025 alone, nearly $50 billion worth of U.S. corporate bonds have been downgraded to junk status. For comparison, only $8 billion were upgraded back into the investment grade category. That is a 6-to-1 ratio in favor of downgrades. This is not just a warning bell, it is a full-blown alarm, especially in a market still pretending everything is under control. So what happens if inflation stays elevated and the Fed refuses to back down? The answer lies in the growing mountain of distressed debt, and it is no longer a small pile. But now it is not just an economic issue. Survival is on the line for many well-known American companies. When large players fall, they drag everything down with them. Take Warner Bros. Discovery, for example, once a symbol of Hollywood and global media leadership, now a so-called fallen angel. That is the term for companies whose credit ratings have been downgraded to junk. Moody's downgraded Warner after the company announced a business split, effectively admitting it could no longer manage its debt. This is not the collapse of a startup or a penny stock crash. It is the downfall of a cornerstone of American corporate and cultural identity. JP Morgan listed the downgrade among the 5 largest in the history of its index, and when giants fall, the ripple effects are felt everywhere, from ETFs and pension funds to the biggest mutual funds. If even Warner Bros. Cannot manage its debt, who else is on the edge? How many of these blue chips are hiding behind polished reports and accounting tricks like stock buybacks? Each fallen angel adds to the systemic risk. With every downgrade, the cracks widen. This is not a hypothetical threat. The collapse has already begun, quietly, behind closed doors. And now the real question is, how much time is left before the dam bursts? Will Washington act in time, or has the reckoning already started? Subscribe to the channel so you do not miss what happens next, because the most important part is still ahead.